Hi, I'm Sameer Jain, founder of ActiveAllocator. As we now make the transition from a startup to an early stage growth company with enormous potential for reimagining wealth tech, I take great pleasure in introducing our firm to you. Let me share with you our mission, the huge investment problem we address, as well as provide color on our evolving industry so that you begin to get a sense of who we are, what we do. We are also looking for early adopters, investors, as well as folks we can partner with. So if this is of interest, do get in touch with me. Let's start with our purpose. We aim to reshape the wealth management industry by resetting advisor and investor expectations about asset allocation advice, where the best advice comes from, what it should cost, and how it is delivered. We know how to increase expected returns for 33 million investors by eliminating the 30% plus annual loss that's built into the way the retail financial advice and investment management industry is currently structured. Our technology removes the deadweight costs of $130 billion in strategic asset allocation inefficiency alone, and we drastically reduce the $300 billion being paid in advisory fees. What's really ambitious is we do it one individual portfolio at a time. Let me tell you what is the problem with our industry. The problem is traditional forms of creating and delivering asset allocation advice are costly, inefficient, and impersonal. They're costly because financial advisory fees automatically destroys over 20% of returns on investor capital every year. It's inefficient for we can now near conclusively demonstrate that bad asset allocation decisions straight away destroy another 10% from return on capital. So this is an egregious 30% value destruction in returns every year. This needs to stop, period. The reason why I said it's impersonal is because financial firms just can't provide personal advice to everyone profitably. And the reality is, few customers want to pay for it. So to serve a broader audience, financial and robo-advisors put retail investors in model portfolios which don't work. They don't account for personal investment views, preferences, limitations. Sadly, nobody is talking about it. Most retail investors actually don't trust their financial advisors but have no way out other than to shop around for someone else. Worse still, clients never really know how inefficient their allocations really are, or how good or bad a job their financial advisor is doing. So all this changes with ActiveAllocator. Which brings me to our solution. Our solution is we help investors analyze existing allocations, discover inefficiencies, and create a bespoke portfolio in 10 minutes, in 10 clicks, and at 10% of typical costs. We are the world's first and only portal that seamlessly and, more important, correctly integrates traditional, illiquid, and alternative investments, private equity, real estate, hedge funds, managed futures, private debt, everything correctly within portfolios. How do we do it? Well, we aggregate and investors in-house and held away assets at over 15,000 financial institutions across the US and Canada. Then our proprietary technology searches, recognizes, classifies, and instantly maps more than 4 million financial instruments to 50 granular asset subclasses in milliseconds. By doing so, we shift the focus from financial products to asset classes, which drive long-term portfolio performance. We also allow users to compare and validate their own market views with capital market assumptions from 10 Wall Street firms. After all, nobody has monopoly on investment outlook. We are all about deep personalization, constraints on specific asset type exposure, aversion or preference for illiquidity, for alternative investments, and expressing a dozen other choices. So our approach to optimization is far ahead of conventional ones built around mean variance optimization and dated modern portfolio theory. Unlike everyone else, we allocate simultaneously across fundamentals, skills, downside risk, and illiquidity. We also recommend new asset classes which you do not own, but which expands your investable universe. And to implement, we give you the ability to securely execute your transactions across a dozen large brokerage firms. Fidelity, E-Trade, Scottrade, Vanguard, Interactive Brokers, we got them all covered. Coming now to technology, our server is based on the Django REST framework. Our database is stored in Postgres. Our backend code is written in Python. We use SSL encryption, modern authentication standards, object level permissions, and much more to protect our users. Our web client, the front end, is a single page application based on the React and Redux stack. Moving on from technology to why now? Yes, many reasons. The financial advice, retirement, and wealth management industries have all been spared convulsive change, and they've been insulated by an older demographic, regulatory barriers, high capital requirements. But the forces of digital disruption that have ripped through news, through music, through travel, every other industry, are now poised for a frontal assault on wealth management, and we want to be the guys that lead this assault. What are the reasons? First, I think, is the wealth tech disruption. Conditions have become much more favorable now. Consumers are ready. Industry conditions favor innovation. And the technologies, or at least the ones we use, that are required to transform financial services now finally works. Second is regulation-driven changes from rules that are intended to eliminate conflicts of interest. Although much uncertainty remains around this, I think the genie is out of the box. Third, of course, is the birth of technology-driven personalization across many industries, and we bring this to financial services. The other piece is the increased adoption of alternative investments by affluent investors, large asset managers with huge distribution systems, and you'll see that right behind me in New York City, continue to develop new investment products, which has increased retail investor access. We've invested 2 years with multiple quant PhDs to develop the data sets and the algorithms that are needed to correctly include them in portfolios. And I say it with some modesty, nobody does alts better than ActiveAllocator. In fact, we have an opinion of counsel from the country's probably most prestigious RSA law firm that supports this. The fifth driver is by catalyzing financial advisor migration to independence from wirehouses, from captive channels. Our system is smarter than probably any wirehouse or wealth management firm out there, and I know it because I've been there, I've done that. Sixth is this new propensity to buy versus build in-house by mid-sized financial firms. And of course, these days, no conversation is complete without mentioning major technology shifts, cloud-based services, low-cost and open-source software development tools, as well as partnering across the digital ecosystem through APIs. Market potential. We serve individuals, wealth management firms, registered investment advisors, and independent broker-dealers, financial advisors. We catalyze strategic asset allocation that can be self-directed, advisor-driven, or collaborative at the advisor's discretion. Unlike prevalent digital tools, we convey the richness and the nuance of human judgment. We tell the individual investor, trust your financial advisor, but do verify with us. Think of us as a second opinion just to be doubly sure. Challenge your advisor to facts. Test your existing portfolio to see how good a job your advisor has been doing for you. Perform custom on-the-fly analysis in seconds. So our prospective customers outside individual self-directed investors will include a subset of 30,000 RIAs and 200,000 independent financial advisors at small and mid-sized broker-dealer firms, as well as advisors attached to employee model captive channels such as regional banks. Also, we are in conversations with the prospective enterprise customers, asset management firms, banks with the wealth management divisions, foundations, endowments, and insurance companies. Which brings me to, how do we create value? Well, our model is to blend the human with the digital. Our platform fosters advice that is collaboratively arrived at between our clients and us. And our approach is to augment advisor-client interactions by bringing in analytics-driven, fact-based, product-agnostic thinking. For financial advisors and RIAs, we enable deep personalization. And in an era where money can be managed effectively, efficiently, cheaply, ActiveAllocator helps advisors move up the value curve. We provide a modern digital advice experience. We recognize that the market of one is the new norm. We drive the individualization of every aspect of asset allocation down to the level of the single client. We promote greater customer intimacy, and for investment-centric advisors, we improve fiduciary standards, grow AUA by attracting and retaining clients, by including alternative investments purposively in portfolios, by promoting differentiation through making personalized financial advice a digital priority. Which brings me to competition. Software companies, old world, established financial software firms, as they have morphed and grown, have become all things to all people. And their offerings are geared to providing the applications and services that financial advisors use to manage their practices. I guess workstation-based deployment for data aggregation and analytics, financial planning, very rudimentary portfolio management, trading, rebalancing, performance reporting, portfolio accounting, CRM, billing calculations, and administration. And within this category, I also include traditional asset allocation software firms that provide software packages for conventional stocks and bonds allocation using archaic mean variance optimization approaches. Some also offer basic research and due diligence on traditional investment managers and funds. In general, most of these compete without any clear source of differentiation in content. Look them up. Most are just tech firms with very little real investment content but if I may use this word, masquerading under fintech to improve their valuations. And extending simplistic allocation and portfolio construction has also led to a proliferation of a new genre of undifferentiated robo-advisors who decry the benefits of active management. So in doing all of this, most have lost sight of the single most important reason that a client reaches out in the first place, which is to create better investment outcomes. So we differ from digital money managers, digital investment managers, digital financial advice providers. We differentiate from emerging robo-advisors that create simple, low-fee, diversified, automated ETF portfolios, largely targeting mass affluent investors. Then there are these wealth management firms. I keep hearing about wirehouses and wealth firms as formidable competitors. Yes and no, yes and no. Most of these provide bundled asset management, wealth planning, investments, fiduciary, risk management services, and are one-stop shops. I believe that unlike them, our advice is independent and objective. We do not draw revenue from soft dollars, from commissions, from captive broker-dealers, from referrals. And you know what? Often these firms are self-focused, driven by firm profitability, legacy operations, approaches with their processes limited to their own firm's products, and they derive revenue from third-party products that they distribute. All of them have a very standardized product sales orientation, while we are product agnostic. Most of these firms lack comfort with non-traditional assets. If they had their way, they wouldn't have any non-traditional alternative investments. Our approach, by contrast, is built around bringing liquid and traditional investing around alternative investments. We are not wedded to products. We are solely driven by allocation and portfolio construction advice. We support multiple asset management platform providers for fulfillment, and we bring the benefits of multi-asset, multi-product inclusion. We also expand the investable universe to products that are available across over 50 sub-asset classes. Which brings me to team. Our team has complementary asset and wealth management, investment banking, software development skills. Collectively, we've allocated billions of dollars in client capital, run large businesses, serve both institutional and retail investors across the world. We've published extensively. So our investing team members have held managing director roles on Wall Street with AR Capital. We've been with UBS Alternative Investments, Citi Alternative Investments, Baird and Company, Morgan Stanley, RBC, Paine Webber, Shinsei Bank, Deutsche Securities. We bring top-tier academic credentials with multiple degrees from MIT, Harvard University, the Fletcher School at Tufts, Technion. We have PhDs, CFAs, CPAs. So the whole is greater than the sum of the parts. To conclude our status, over the past 2 years, we've formed a team, we've validated the market potential, we've invested our own as well as raised external capital that was needed to execute on our business plan. We've built an enormously sophisticated product engine. We've developed valuable IP. Check out our website. We've exhibited thought leadership. We've participated in industry events. We've entered into complementary product and partnering sales alliances. We've had success with trial customers and are being used to manage large amounts of high net worth investor capital. We are also beginning to attract industry attention, and we were featured by a leading fintech investment bank as an emerging wealth tech global disruptor. So now we are going to go for growth. We've started identifying key prospects, having sales conversations, and we've been fortunate to meet with early success by way of pilot projects, which I anticipate will convert into revenue generating opportunities. So right now we require early stage financing to build upon our success, to invest in product development, in gaining market traction, in demonstrating revenue growth. So if any of this is of interest, do get in touch with me. Thank you for listening in.